Hi there. I firmly believe that we are facing a significant crisis in our country around retirement. You may be feeling yourself, your parents may be feeling it. Certainly, I see the evidence all around me in my business and my day to day activities. However, not a lot of people are talking about it. There's a lot of data out there. There's a lot of information, but I don't really feel like it's getting through to many people. And that we have options. The great news is that, especially here in Southern California, where I live, but in many parts of the country, there are significant other options that people can look at that they don't look at because they're fearful or they don't understand it, or they don't know. Right. So we're going to just address some of those today and go through those options and just kind of create a conversation. So my name is John Thompson. I'm the founder and lead advisor at SMPL Mortgage. I've been in the mortgage industry for 32 years, advising and helping clients and working with other financial professionals to help people create a better lifestyle for themselves, whether they're a first-time home buyer or planning for retirement or in retirement and so forth. So let's get to it over here. And we're going to talk really about paying attention. Things are happening, right? Inflation is running rampant right now and maybe for a couple of years. The cost of healthcare is accelerating. We know this. People really want to enjoy their lifestyle. Certainly in retirement, they want to enjoy a lifestyle. We're seeing more and more multi-generational decisions happening. We're going to talk about some of those today. And this is not to create fear, but just to understand what's going on out in the world these days. And are you paying attention? And are you checking in with those around you that you love and that love you to be able to make some important decisions around finances and so forth? So this is Dodge a Crisis in Retirement. Our mission at SMPL Mortgage is to be changing the world one family, one home, and a mortgage at a time. And we firmly believe that's what we do, is we give great advice and help people make good decisions. So some quick facts. Did you know that 50% of people going into retirement have a traditional mortgage? And typically that mortgage is 30 to 50% of the monthly income. So think about your own situation. Are you entering retirement? Are you thinking about retirement and still have a mortgage? And what does that mean for your ability to have the lifestyle, enjoy the lifestyle you want to have? In 2018, which is the most recent data that we were able to get, over 1 million applicants over the age of 62 were denied a mortgage. Denied. They were turned down because they did not make enough income or had too much debt, so excessive debt to income ratios. In 2018, that same year, 1.3 million mortgages were made to borrowers over the age of 62. Only a small fraction of those were reverse mortgages. And just putting aside how you might feel about reverse mortgages, that product is designed specifically for retirement, specifically to help sustain people and create a better lifestyle in retirement. And we'll talk a bit more about that later on. But a very minuscule product that's set up by the government to help people in that age group. This is only 1 year's worth of data. This has been happening every year, and it's only accelerating as baby boomers enter retirement. we hear those numbers all the time, 10,000 people entering retirement every day, and I think it's actually more than that here after the pandemic. All right, so what does it all mean? Debt is going to be a major headwind for a sustainable, and we'll use that word sustainable, retirement for millions of American homeowners. What does sustainable means? It means that you're going to have enough money to be able to live your lifestyle and protect yourself and take care of your family. And if you want, give away some money to other people in your life. So that's sustainable. It's going to put a lot of pressure on families, right, to sort of step in. Government agencies, which are already stretched, there's a lot of money going into this world right now. Private agencies that support, this space and senior homeowners and so forth. And then let's talk about well-being, right? So personal health and well-being are going to be impacted in a couple of different ways, right? Not only just longer working hours, but just the stress around making ends meet and sort of feeling the pressure from the different things, are not going to lead to great outcomes typically. So I want to share the story of one of my favorite clients. She's a teacher, retired now. She was not retired when I met her. She had a condo down in the San Diego area, and she would really like to spend more time with her kids and her grandkids. The kids are the ones who actually came to me, the adult children, and said, hey, we were considering making her mortgage payment so she can stop working because we'd love her to be around our kids more and spend more time with her. But it's tough because she's working full time, right? So at the end of the day, we got together. We had a whole big family plan. We paid off the mortgage, which eliminated $14 a month in payments. We paid off a car that still had significant payments on it, which freed up another $380 in cash flow. So there's almost $1,800. And on top of that, we added what's called a 10-year payment, about $1,200 a month to her income. So now you got a total of, what is that, about $3,000 a month in additional income that she didn't have before to be able to live her lifestyle. And we created a line of credit as an additional kind of safety net. So she's in a great position. And the best part of the plan, which I really enjoyed, is the kids want to start supporting her, right? Once she got over the fact that she was trying to do things for adult children, she was able to move forward with her financing decision and clean all that up in a much better situation for everybody in the family. Three different generations now get to enjoy that one transaction that she did. All right, so let's talk a little bit about retirement income planning. So retirement income planning is an interesting concept. Really what we define it is as a coordinated approach to an investment portfolio and house equity. But retirement income planning is around, do you have enough assets? Do you have enough income coming in to be able to support the lifestyle you want, to be able to provide protection, pay for healthcare and everything else? It's very different when you're in retirement than when you're growing your money, right? So when you're working, income all comes from your work typically. When you're retiring, it's not coming from work necessarily anymore, but it's coming from these other sources. Are those sources enough to provide you with the income you need? A lot of traditional financial planning really only looks at the house, right? So we're really talking about this coordinated approach between the house and your other assets and other resources. But a lot of financial planning only looks at the house as an exit strategy to access those funds on a sale. And the short-sightedness of that approach is clear, because what that really means is, hey, we're going to spend everything else, and when you run out of money, we're going to sell the house. And no matter when that is, isn't necessarily the greatest plan at that point, because maybe someone can't afford to move, maybe they can't move, maybe they don't have the physical ability to move. And they're forced into a situation because they haven't done planning in advance. And so that's the big thing there, is being forced to make a decision later on in life. Really, the ultimate goal of retirement income planning is to use all your assets to allow for more income and for potentially a larger legacy. Retirement income planning looks at things like income and contingent expenses. Those are other things that might come up. And legacy planning, when you want to leave money to other people. A lot of the risks around this are, you're earning less money. How long are you going to live? What's the cost of long-term care, in-home care? Sequence of returns risk is when the stock market is down. You don't want to pull money out of the stock market when it's down, like it is right now in 2022. Spending shocks, unexpected things that happen that take up a lot of money. Declining cognitive ability, your own ability to make good, clean decisions. And of course, public policy risk when the government changes something that affects our planning. The great news is that in many parts of the country, but especially in Southern California, that ranch home is worth a lot of money, right? So the equity is growing tremendously, and it provides an opportunity that maybe didn't exist before. And even if in other parts of the country where it's not quite as expensive, it's all relative, right? So if a home has tremendous equity in it, there could be a way to maybe use that equity to create a more sustainable plan. So when we talk about home equity, we're really talking about the home value, the value of your home minus any debt that may be against it, right? So if you have $1 million home and you owe $400,000, you have $600,000 of an asset that you can't get to. Right. And so we believe the coordination of cash flow and finances is critical, both on the income asset side, but also on the debt and payment side, the side that I work on in the mortgage space. So these are different things you could consider to do with your home. You could sell it, which creates liquidity and reduces expenses. You could look at a refinance, which would mean, are there cash flow or liquidity options that could make sense? Maybe there's a line of credit. Maybe there's access to private money you needed for short-term situations. You could look at a reverse mortgage, which I think is an appropriate strategy in many cases. And there's two different programs in that world. The home equity conversion mortgage, which is the FHA or HUD insured, government insured program, or this portfolio for much higher priced properties. There's a new product that came out this last several months called a hybrid mortgage, which improves cash flow today, leading to no payments in 10 years. And then finally, there's equity release programs, which we'll talk about. And we'll talk about each one of these in a little bit more detail, which allows you to sell a portion of your equity now but retain ownership. There's lots of government programs, and I really believe that wellness care can and should include a focus on finances. After all, it's all fine and good to work on the mental side of it, and that's really important, and the health and well-being side of it. But part of what our lives are driven by cash flow, right? We know our lives are driven by cash flow. So let's talk about the sale of a home. You could plan to trade down or even trade up, right? We see people doing both these things, but the objective is to free up capital while creating a sustainable housing situation. So that's an important key component of this, housing. So when you're selling a home, there's the cost to sell, there's commissions. Maybe you got to fix up the home before you sell it. There's a lot of time and effort involved in that. You also have to deal with the replacement home. Is it in the community that you want to live in? Is it near family? Do you have to move away from family just to be able to afford something? What are the access to services? There are people who have been wanting to run to these remote places now, but if the hospital is 2 hours away, is that a safe thing or not? And of course, medical care, leaving doctors, changing doctors, those types of things. And we should be looking at taxes. I mean, there are capital gains. I know just our own clients, how many people won't sell or firmly believe they shouldn't sell because they owe the government several $100,000, and they just can't see parting with that money to give the government taxes, right, when they could continue to live in their homes. Maybe they want to transfer their tax base to their kids. Maybe there's an inheritance, or gifting tax situation. These are larger strategies that we discussed with CPAs and other financial professionals. I want to know, you may realize this, but generational living really is happening, right? So this is a client of ours. They're adult children. They're in their mid-50s. They realize that they have a retirement financial gap to fill in a short amount of time, right? They want to retire at a normal time frame, but they don't really want to be forced to work into their 70s or 80s. A widowed parent of one of the adult children has a free and clear home, some Social Security income, but limited liquid assets, and is going to need significant care over the rest of her lifetime. So what are the options to think about here? You could sell one or both homes and downsize, or maybe move into one of those two homes. They could buy a new home, maybe with a guest house, or build an accessory dwelling unit, like a guest house type of thing, and combine the two households together. Or potentially move the parent into assisted living, and with the amount of equity that she had, she could live in a very nice facility. And some of those are spectacular facilities. What are some of the concerns? Access to healthcare, community, extended family, the cost of living in Los Angeles and Southern California. Of course, the concern over combining households. Is that even going to work? Can we get along? Can we live together? Is that reasonable? And then, of course, there's tax implications that we talked about, capital gains and Prop 19, and is it in alignment with the overall estate plan? At the end of the day, they decided to sell both homes, which freed up about $1.3 million in cash. They purchased a $600,000 home in a less expensive area. So the benefits and the outcome here are that the parent added $500,000 in liquidity, which essentially becomes long-term care coverage, for in-home healthcare potentially. They transfer the new property tax base to the new home. The kids are in the home, which is helping with care and support while aging. And of course, it reduced living expenses overall for the parent. The adult kids, because they sold their home, were able to add a couple $100,000 to their retirement funds. They get to keep the home they moved into together with the parent's low tax base later on. They could leverage the home for additional liquidity, because it'll be free and clear at the time that they take over the home. And of course, they enjoyed a reduction of living expenses because they no longer have their home, the taxes, insurance, and mortgage payment on that home as well. So a win-win for everybody, and that's a successful story, and we see that happening more and more every day. Let's talk about kind of refinancing, right? So the goals of a refinance would be to maybe improve cash flow. Maybe it's to do some home improvement to make a home more sustainable. And maybe it's just emergency liquidity, right? There's just an immediate cash need. We look at payments, and ideally you're aligning payments with income. What I mean by that is that as income changes in retirement, the payments oftentimes are much too high. And so how do we get those payments back down to a level that's manageable? And maybe we see people going from 15 to a 30-year. A lot of people take 15-year mortgages in their 40s and 50s in an effort to get rid of that mortgage, and they don't get there. Right, they can't get there, so they got to go maybe back to a 30-year fix, which I think is fine. It's just about cash flow again. Maybe they're going from an adjustable to fixed. They look at interest-only mortgages, and maybe they even pay down the balance, going back to that align payments with income. What about taking some of the other assets, reduce the mortgage balance, which allows you to get a lower mortgage payment? That could also be a strategy to look at. When you talk about aging in place, if you decided to stay in the home, maybe there's home updates to make the home more livable for older use and so forth. Do some improvements to reduce the overall maintenance expense. Maybe plan for in-home care. Do you need to plan for a space for an in-home healthcare person to be able to be there part-time or full-time? Maybe you're creating this ADU, this accessory dwelling unit for generational living. The parents moved in the ADU, or the kids move in the ADU, or maybe it's here for a caretaker. All sorts of different options there, or maybe it's just additional income. You could also start planning in advance for co-living, co-housing. That's where, maybe 2 or 3, widowed or single adults moving together to share resources, share expenses, and have companionship and all the other things that are important. And then also on the finance side, you're talking about combining debts, paying off other debt. Maybe setting up a line of credit for safety. Maybe there's advanced gifting, right? So the idea of I want to leave my home to my kids, but why should they get it when why should they wait until I pass away? Maybe you advance gifts some money, which alleviates that mental block, and you've given them something they can use during their lifetime for themselves and maybe for their kids, and you've removed the objection in your own mind about I want to leave something for my kids because now I've already dealt with that. All right. So again, a couple of real stories, real lives here. In this situation, we have a dual income couple in their mid 50s. Excuse me. Their income is about $90,000 annually from employment. They got about $260,000 in qualified plans. They've only got about $50,000 in liquidity, meaning just cash in savings. But they've got a $960,000 home with a $250,000 mortgage where they've been paying extra on to try and get it paid off before they retire. And their objective would be to stay in the home. So what do? They wanted to move to a 15-year fix to try and pay off the mortgage before retirement. We got together with their financial planner and talked about the big overall plan, right? So we actually moved them to a 30-year fix with the lowest possible payment. We stopped making extra payments. The advisor ultimately modeled, putting sustainable income with Social Security, the assets, and continue to add to savings and qualified plans while they're still working. So their plan was to work another 10 years based on the numbers that they could save both in the cash flow of the mortgage and not paying extra and putting a little bit extra money towards savings. They were able to make a sustainable plan. And then we're going to look at age 62 about maybe we look at a reverse mortgage at that age, and we model that out for as part of the overall plan. And we'll look at that in a few years. Another profile, a single woman, 61 years old. She's got about $140,000 in normal employment income. That's her salary. She's got $650,000 in qualified plan. She sold a home in 2020, and she bought a new home for $900,000, and she got a 10-year adjustable mortgage at $500,000 because she wanted the lower payment, and she'd love to stay in place. So you might look at that profile and go, well, she's in pretty good shape. She makes good money. She's got good assets. She's got a nice home, but her plan is not sustainable because of the payment. So the advisor did not want the unknown impact of the adjustable loan in 9 years to affect her planning, right? He doesn't know what's going to happen with rates. No one does in 9 years. So we coordinated the plan. We moved her to a 30-year fix, which gave the assurance of what the payment was going to be. So now he can develop a plan for her, and she can stay in the home with her current assets and projections and so forth. We did also discuss a reverse mortgage option down the road if she wants to retire earlier. She's loving her job. So as long as she's earning that salary or more, then she's in great shape. But as soon as she's not earning that salary, then maybe we look at reversing the flow of that and creating a more sustainable plan around that. All right. So now we're starting to talk a little bit about the reverse mortgage or the home equity conversion mortgage. Let me talk a little bit about what that means and what you need to know about it. So on a forward mortgage, a regular mortgage, you make payments to pay off the mortgage. On a reverse, you either make payments or you don't make payments at all, and the mortgage is paid on the sale. It's just like any other mortgage. When you sell the home or move out of the home, the mortgage is paid off with the sale of the property. So a couple of things you need to know. So the significant changes occurred in 2015 that created a far more sustainable program. A lot of protections were put in place for seniors. NBS stands for non-borrowing spouse. So there's additional protections put in for some reason. If the spouse is not on the mortgage, they're still protected. You had to qualify for the mortgage now with financial assessment. There's limitations on the amount of money that can be pulled out of the home, and they've reduced the amount of money you can get, all in an effort to make the program more sustainable and safer for seniors. How do you qualify? It's got to be, you got to own a home, obviously. It's got to be your primary residence, and you have to be 62 years plus. And I have that little note, 60 portfolio. There are some programs now that actually go all the way down to 55. So some jumbo portfolio type of programs are eligible. If you're over 55, you can get into them. The type of home is a single family residence or an approved condo or even a 2 to 4 unit owner occupied type of home. The amount of money you can borrow is based on a couple of different variables. It's the age of the youngest borrower. It's the home value, the expected interest rate, and each year it goes up, right? So the older you are, the more you can borrow. And so kind of assume maybe a 38 to 48, and that actually is a little bit over that now, maybe about a 52% loan to value, depending. So just on note, you can get to a little bit less, or about half of your home equity is what you can borrow in that situation. So another one of our fun and great clients that we have. So this couple's retired, they're 65, 64. You'd call these people mass affluent because they got good income, got a home worth $1.6 million, they got $1.5 million in the bank and IRAs and assets. But guess what? They're concerned about outliving their money and being forced to sell the home. See, this is a fear a lot of people have. It's like, well, we think we can make it, but we're not sure. And what if we're forced to do something later down the road? Not a great feeling. So what did we do in their situation? We paid off the mortgage, which eliminated $2,300 a month in a payment and cash flow going out. We set up a reverse line of credit. It starts at $250,000. It's going to grow every year. Within about 10 years, that'll be up to about $500,000. They're going to delay their IRA distributions for as long as possible. They could use that line of credit for income and cash flow as they need it now. So the one big strategy is delaying your required distributions, which reduces the tax. They don't have to take any more than they have to, and so forth. A great strategy there. Also, they could delay Social Security, right? And again, allow that to grow a little bit more. And they're using the line of credit during a down market to avoid liquidating their investment portfolio. So when the market is down, again, you don't want to pull money out of your investments. You want to sort of pull from any other source you have. And that's what sort of their picture look like. One quick note, a home equity conversion mortgage or a reverse mortgage can be used to purchase a home. We see people doing this more and more and more, where you're downsizing to add liquidity. A quick example, let's just say you're selling $1 million home and you decide to buy a $500,000 home. Sometimes people say, great, I'm just going to pay cash for that $500,000 home, which gives me still $500,000 in cash. But what if you sold that $1 million home, bought a $500,000 home, and took a $250,000 reverse mortgage? Now you've got $750,000 in cash, advanced gifting, more liquidity, larger lifestyle, or quite frankly, you could buy another $1 million home, put $500,000 down, and have a $500,000 reverse mortgage. All right, so that can all be done with HECM for purchase. There's nothing unusual about it. It's just an FHA loan. The buyer and seller pay typical costs. The down payment is just over 50%, and it's pretty much the same timing as a normal mortgage. The benefits are you get to preserve your cash. There's no payments required for life, although many people do make payments. We're not going to talk about that strategy here. You could overfund the mortgage, create a larger growing line of credit, another advanced strategy we won't dig into too much here, which you can increase your purchasing power, and maybe you buy two homes potentially with it. You could buy a primary home and a secondary home somewhere else. Another lovely couple, retired police officer, and she was an office manager. They wanted to travel a lot more and not be tied down to their home necessarily. So they sold their home in the San Gabriel Valley. They netted about $700,000. They were going to pay cash for a condo. They have good retirement income and other assets. They're okay there. But they decided to take out a $350,000 reverse to increase their liquidities. They had no specific legacy plans, meaning they didn't have the mindset they have to leave their home to their kids. They've helped their kids with down payments and education. And so they sort of cleared that hurdle in their life, at least mentally. So the reverse mortgage allowed them to free up about $340,000 in cash for investing, for traveling, for fun. That's a lot of travel, right? They're using the condo. They're purchasing condo with no reverse mortgage, with no payment ever. And they have a small line of credit that's going to kind of increase over time. So again, kind of a win-win and great creative kind of story. So let's talk now about another one of these options. And this is that hybrid mortgage that I referred to a little bit earlier. And we're going to call this kind of a new retirement cash flow tool. So it's a retirement mortgage for those who really don't want a mortgage in retirement, because we know that at the end of the day, no one really wants to go through retirement with a mortgage, but unfortunately it just happens. And millions of 60-plus homeowners really do. So this particular product is ideal for those looking to free up some cash flow without selling their home. Maybe you're creating a more sustainable retirement plan. Maybe you want to get a little bit of equity out of your home, that's cash, to be able to do something else with. And they want to refinance, but they may not qualify for a conventional mortgage. Sometimes it's really difficult to qualify for a conventional mortgage as you're in retirement and don't have the same income as you did before. So this hybrid mortgage really combines together the advantages of a traditional forward mortgage and the benefits of a reverse mortgage. Essentially, it starts with 10 years worth of required monthly payments, and then mirrors, and it becomes essentially a reverse mortgage at the end of 10 years by eliminating the requirement to make a monthly mortgage payment for the life of the loan. The borrower is still always responsible for paying taxes and insurance obligations. It's a fixed rate loan. There's partial interest only payments required, and you can make any payment you want. And after 10 years, again, nothing is required at all. And if there's any available money to you, you can pull money out of the product as well. So there's a lump sum possible with it. Got to be your primary residence. You got to have at least 10 years left on your current mortgage. You got to continue to pay your taxes and insurance and other home maintenance stuff. You got to be 60 years old. And you got to be unable to qualify for a normal, regular reverse mortgage. And then it's got to be a $100,000 mortgage minimum amount. The last kind of option that we talked about in dealing with your home equity was what we call these equity release products. There's two categories of these. These are very popular in other countries. They're not so popular and haven't gained a lot of popularity here in the United States, but they're starting to become more popular. In fact, we had a client that opted to take one of these recently instead of a reverse mortgage. And so there's reversion, which means you're selling your home at a discount today and you stay as a tenant for life. So that the investment company buys your property, you basically just stay there the rest of your life without making payments. There's a significant discount to it. They say if the property's worth $1 million, they're not going to give you $1 million. They're going to give you a much lower amount, but they're going to let you stay in that property for life. There's also a shared appreciation product. Essentially, this means that they give you a percentage of your home equity. It's not a large percentage, but they give you a lump sum today in exchange for a portion of your future gain. So essentially, they're betting on the gain in the property. You're getting some cash today. You also participate in that, but it's at a much smaller percentage. So these are interesting products that don't require the mortgage process and those sorts of things. And they may work in some situations as well. We're going to talk a little bit about kind of one of the strategies. I don't want to spend a ton of time going into strategies here because there are a lot of them, but we can say that for another time. But we're going to talk about just this one, what we call the planned trade down strategy. We've had many clients look at this. So it's really a real estate and financial planning approach where there's an immediate or future planned sale of home is utilized to accomplish other kind of goals, right? So this is someone who wants to increase retirement income, maybe diversify their assets. They want to protect their assets. Maybe they want to increase their asset value. So you understand the idea of a planned trade down. A trade down is simply selling a home and buying something cheaper, right? At its very basic level, it's selling something and buying something cheaper with the idea that now you got a bunch of cash, right? And everyone's familiar with this idea, but how is it done and is it strategic? So again, this is John and Sarah Patterson. They're 65 and 62. Their homes are worth about $800,000. They've got a $200,000 mortgage on a 15-year fix. That has a payment, you'll see it right here, of $1,854. Their taxes, insurance, and maintenance cost them about $1,400, $1,500 a month. They got about $55,000 in a savings account. They got a couple of money in a portfolio. From an income perspective, these things ruffle a little bit of income every year. They have a company pension, which is nice because not a lot of people have pensions anymore, and they're taking a little bit of Social Security income. So here are their assets: $992,000. $3,320 expenses, $5,600 in income. So they have to live on $2,300 a month. And you might look at these people and go, well, they seem like they're okay, but they're living on $2,300 a month. So what could be done for them? So they buy a new home, they sell their $800,000 home, they buy a $400,000 home, and they use an interest-only mortgage, right? So this diversifies everything. Current value of the home is $400,000. Here's the mortgage payment on it. Here's the taxes and insurance. I'll make a quick note here. They could also potentially transfer their tax base if it made sense to do that. But we didn't do that in this example. So you get $966, taxes, insurance, maintenance. They put a little bit more money in liquidity. They took a lot more of that cash and they diversified it into different portfolios. They bought indexed universal life insurance. So this is to increase their estate value. And this L to D, second to die, means that when the second spouse passes away, whoever inherits that money gets that money. And then they want to set up long-term care for both spouses. And don't get stuck on the numbers, right? Long-term care is probably more expensive than this now. But at the time this example was done, it was in the ballpark. So anyway, it still be done. So they're still the same assets, right? So the same 992 assets. Their expenses are down a little bit lower, and they got a lot more income. So now they've got $4,300 a month in income. So they've almost doubled their income by making that move. Now, what if we did the same thing with a reverse mortgage? So again, sold $800,000 home, they buy a $400,000 reverse with a reverse mortgage, right? So now they got a $400,000 home, no payment over here. Same expenses around taxes and insurance. All right, so they put some money in a CD. They got a single premium insurance annuity, which simply means they put $200,000 into basically an investment insurance product, which throws off guaranteed income over life. So that's over here. They could take payments from the reverse mortgage if they wanted to. Again, the same life insurance strategies here to create more value for their kids, protection around long-term care, more diversified cash, the same 992, right? So we're not changing anything, 992, but now the expenses, down to 1638, income's up to 7,700. Now they got $6,100 a month to live on, significantly more than the other two options, right? So just a quick recap of it all. Same asset value before, the forward mortgage and the reverse mortgage, 992 assets, expenses 3,300, 2,600, and then 1,600. Income here net 2,300, 43, almost 4,400, and 6,100. So pretty powerful stuff when you see it in action. At least I believe so. Right, so what were the goals to accomplish? They increased their income. They freed up $400,000 tax-free. Remember, that money wasn't taxable. They were a married couple, so they have a $500,000 exemption. We increased the income by either a little bit over $2,000 to $3,500 a month. We accomplished diversified savings into additional funds. We increased their estate value by getting the life insurance to give to their kids when they pass away. There's also some cash value, by the way, that life insurance is growing over time they could use during their lifetime. And then they've protected everything by getting long-term care insurance, which is the biggest gap for most seniors, is they don't have long-term care insurance. They got to figure out a way to pay for that out of cash and cash flow. The cool thing is a lot of people are involved in this type of planning: realtors, financial planners, insurance, estate planners, and the mortgage people. So that's it for the most part here. This is recording. In the live class, we'd be doing questions, but you can always call me as well and talk through these things. A couple of things that we really want to share with you, drop an email or give us a call. So we do these conversations all the time. So we call this our Bar Smart conversation. We have a pre-retirement. If you're not retired yet and you want to sort of look at the options and think about the options, we can help you think through the things that might happen in the next few years. If you are retired, then of course we can put together a plan around cash flow and help you think about that. Ideally, we're combining that with some sort of a financial advisor. If you don't have a financial advisor, we can suggest and recommend something. If you're interested in getting, we have a fantastic tool. It's called HomeBot, and it delivers a real estate monthly report that's far more detailed and far more creative than the ones you see out there on Zillow and Truly and some of those other kind of sites. This is truly a report that's customized around your own property and your own mortgage and your own kind of goals. So we'd be happy to set you up on that as well. All right. So again, I'm John Thompson, mortgage advisor, been in the mortgage space for over 32 years. Love this kind of advice and planning. Feel free to reach out anytime. We have an office in the San Gabriel Valley and also in the Coachella Valley. There's our phone numbers and my email, john@simplemortgage.com. And thanks very much for your time. I hope you learned something fantastic and have a great day.